Some people are calling it a reset, others feel it's a bubble, and some others even feel like it's a pre-crash and pre-crisis market. Whichever way, it all points in the same direction. The housing market has turned upside down. What used to be stable and predictable is now volatile and scary. And while greedy investors and home flippers are cashing in on this mega upsurge, it makes you wonder about the fate of the common people of America. Single-family homes now cost a fortune, and just when you think it can't get any worse, you're hit with a rude awakening with the next day's home prices. Home experts are calling it the post-pandemic home bubble, but when will this home bubble pop? Well, it's not up to me. If anything, it's up to you. You see, at the end of the day, home prices are determined by supply and demand. It only takes a small number of sales at obscure prices to push home markets to new price levels. If about 3 houses in your local area sell for twice the normal price, don't be surprised to find all the homes the next day with double the prices they sold yesterday. Real estate marketers never fail to seize an opportunity, and this trend could be a major contributor to the 2023 market bubble. But the same trend can also happen in reverse. If buyers become scarce, consequently, prices will drop. As sales continue at these new reduced prices, other homes too will be forced to join the trend. Recent data has shown that 37% of homes are selling above the list price. This is far worse than during the pandemic, when only 20% of houses were selling above the list price. Could it be that the homeowners and flippers are to blame for this current crazy bubble? Not quite. As you well know, everything housing experts had predicted about the market turned out to be wrong. Interest rates increased over the past few years, and bidding wars for the few homes available have become the norm again in several parts of the U.S. Interest rates are now at 7%. No one knows if it will get worse from here, or whether to expect a miracle. Buyers are in a dilemma, while flippers are praying that a crash like that of 2008 doesn't repeat itself. But at the end of the day, the truth is that nobody wants to buy or invest in a bubbly market on the verge of collapsing. Real estate used to be a very bullish investment. It still is. But who'd want to put their money in a market that may result in losses over the next few months? But be that as it may, investors usually have the mindset that home prices always go up. So even if a crash occurs, home prices may slowly pick up over the next decade or so in obedience to the rule. While this may be true, there's also been a lot of substantial evidence in the past to prove that even real estate sometimes struggles to follow the high road. For instance, the New York real estate of the 1930s didn't yield much profits for investors until well after the 1970s, meaning these guys had to wait almost a lifetime before finally cashing out from their investments. However, in the meantime, buyers, flippers, and investors alike are faced with a problematic situation. As regular people struggle to find affordable homes, a crisis is imminent. In fact, some experts feel that the great financial crisis of 2008 is still playing a huge role in what we're seeing today in the home market. A recent statement from Deutsche Bank goes, "The U.S. housing market was simply navigating a mid-cycle crisis with higher rates and home prices acting to govern, but not to derail a cycle that had started over a decade ago in the wake of the great financial crisis. Right now, there's no assurance that the bubble will burst this year or that there will even be any sort of relief, especially if you're going by the history books of what played out during the last big crash of 2006. At that time, the U.S. housing market reached a peak and perhaps would have continued its ascent if not for the great financial crisis that began to set in at the end of that year. Thanks to the growing crisis, a bear market began for U.S. homes, and over the course of 5 years, prices had reduced by 27%. U.S. homes hit an all-time low in February 2012, and almost immediately, a new bull market began. House prices rose from the ashes and never looked down for the next 11 years, surpassing the previous peak in 2006. But by March 2020 came the turning point when things went haywire with U.S. housing. Prices exploded beyond imagination, and from then till 2022, home prices increased 43%. To give you an idea, this means a home that would have sold for $900,000 in 2020 would sell for nothing less than $1.3 million. come 2022. That's an insane growth in housing rates for a mere 2-year time frame. How should citizens cope with such prices alongside the increasing recession and unemployment rates? The most upsetting part was when prices began to decline again by the summer of 2022, and we thought it'd all be over soon. You can see the sharp decline indicating a massive drop in home prices. But then, after about 6 months, the bubble started again. This strange pattern in just a few years shows that no expert can really tell how this thing will go. You could wake up the next day to a bigger bubble or a sudden burst. The reason is that there are too many factors at play here. Consumer behavior has changed, inflation and interest rates are on the increase, recession is at play, and investors are greedier than ever. And so right now, 80% of mortgages in America are locked in with rates below 5%. Folks are no longer willing to sell their homes they once bought at low interest to buy a new home in this current problematic market with interest rates of 6 to 7%. I mean, just do the maths yourself. How can you make profits in a market like this with higher taxes, interest rates, and contingencies? By the way, before we move on to the best part, if you've enjoyed this video so far, hit the subscribe button so you don't miss out on our next updates. Homeowners are doing the smart thing by staying put. Meanwhile, buyers are left frustrated with the fewer inventory available. Just looking at the Redfin median numbers is enough to discourage you from buying a home. This chart shows the average median sale price of homes sold. See the chart for 2023. The median sale price for July 2023 was about $382,000. This is very close to the numbers at which prices peaked last year, and it was still during the same month, July. From August, the 6-month decline which we talked about earlier began. It'll be interesting to see how this year's trend goes, and it's safe to say it will play a major role in determining the fate of the U.S. housing market come winter. Homes, which used to be a stable asset, seem more unpredictable, like cryptocurrencies. Before, you could comfortably compare listings and see competitive prices, but now you can't find many listings anymore. You're probably only going to find one listing per neighborhood. This is a bad sign, and it's one of the things that can make this bubble grow even larger. You see, the supply-demand relationship is a big player here, as it has always been. The fastest and easiest way home prices can decrease is if supply somehow exceeds demand. But from the looks of things, this isn't going to happen anytime soon. In fact, some experts have predicted that we might just end 2023 with fewer houses than we had for sale by the end of 2022. The National Association of Home Builders has also predicted that the current housing shortage will continue for this entire decade. If these prophecies are true, then it's going to be a really bad year, or decade, for home buyers. The only respite will be if more and more homes begin to reduce property prices. Going by the Altos chart, price reductions were at 30% in June. July seems to be starting an upward trend, but not much can be said until we see how August plays out. If prices can reduce by 40 CO or more, there just might be hope for the US home market. One other thing we can't fail to analyze in this recent home market fiasco is the debt-to-income chart for home buyers. Just so you know, the homebuyer debt-to-income ratio, or DTI, is the percentage that reveals how much money homebuyers are spending on monthly debt payments compared to how much money they're receiving or earning. This value can be obtained by dividing your monthly minimum debt payments by your monthly pre-tax income. As you can see from this DTI chart, the 2023 homebuyer DTI is now at 40%. In other words, home buyers are going through hell, spending 40% of their income, excluding taxes, to pay up their mortgage debts. The last time U.S. homeowners went through such hell, what followed was the worst housing crash in history. Is history about to repeat itself? In addition to the high debt-to-income ratio, people are making even lesser down payments on mortgages. During the 2006 housing bubble, the average home buyer's down payment was about 20%, but in this 2023 bubble, we're seeing rates of less than 18%. So home buyers are putting down less and using up more compared to 2006. This further proves that we may be in the worst housing bubble ever. To put things in perspective, Picture this. Back in 2019, a new home buyer in the US could secure an average home for $1,300 a month. But now, in 2023, home buyers can only purchase such homes for $2,600. Add that to the crazy interest rates, and you can see that the market is going in for the kill. In just 4 years, the prices of homes have doubled for home buyers. The sad thing is only new buyers will feel this heat. Old buyers or current homeowners are simply hanging on to their properties, enjoying low interest rates. This is why the number of home sales in the US has declined massively since 2022. And so, if anybody is praying for the market to crash, it's the new buyers. However, even if a crash does happen, it will be more severe in some regions than others. Home prices have always varied by region. The United States is home to over 50 metropolitan areas. In each of these areas, you'll find a unique housing market independent of all the others. This is why, for the remainder of 2023, experts have predicted that prices in the West will be more unstable compared to the East, and home prices in the South and Midwest regions will be the most stable. Unstable here means fluctuating prices, and just so you know, there's a greater chance of prices going bullish than bearish. For instance, from May 2022 to February 2023, prices of homes in Austin, Texas plummeted by 23%, causing some experts and investors to panic. Some even called it the epicenter of a market crash. But since then, prices have risen by 15% in the area, proving that there was no impending crash at all. A similar scenario played out in other regions in the US. So, at the end of the day, there is little or no chance that we will get a market crisis that will rattle prices back to the all-time lows we saw in 2007 to 2008. So, where does this leave us? Does it mean the housing bubble isn't going to burst? Well, like I said, so many factors are at play here, so things can go either way. We just have to wait and see how things play out. Remember to subscribe to our channel if you found this content valuable. We'll see you in the next one.